Good morning and welcome to today's webcast, Tax and Compliance Treatment for Your Organization's Fringe Benefits. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters, Tracy Paglia, partner in our not-for-profit practice, and Susan Mehlman, director in our compensation and benefits practice. And before we get started, we are going to start off with a polling question today. How familiar are you with the changes to the laws governing meals and entertainment and fringe benefits that may impact your organization? And your options are very, I'm up to speed, somewhat, or not at all. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit submit. If you're having any difficulty seeing the poll, please try refreshing your browser with F5. Give everyone a few more seconds. And let's go ahead and take a look at the results. And Tracy, I'll turn it over to you.
All right. So it looks like for the attendance we have on the call and those answering the polls, we've got a large majority that say somewhat familiar with the changes in laws that are governing meals and entertainment and fringe benefits that may impact your organization. So we'll be helping you a bit talk about fringe benefits today in relation to tax reform, and certainly have a lot of materials and slides for you if we don't cover it in as much detail as you would like, because we do only have an hour today, and we could go on for much more than that relating to tax reform changes. What we thought we would do today is walk you through the basics of fringe benefit exceptions and exclusions and point out where things have changed along the way. So we are including examples on when the different exceptions can apply so that you can understand the basics to apply them to your particular fact pattern. So to start off the discussion, I wanted to remind everyone on the call that anytime you have a transfer to or for the benefit of an employee, that item is going to be taxable unless there's an exclusion. So there's no fairness principle here. It doesn't matter that an employee lost their home or had a significant medical emergency. If you do something for the employee, if we can't find a way to exclude it, it's going to be taxable income. So I always start my fringe benefit discussions that way, so that you can understand the government wants to tax everything, and if we can use the rules to our advantage to provide something for employees in a tax-free manner, that's great, but our basic starting point is it's taxable. As we're talking through this, most of the time these exceptions and exclusions are going to make it non-taxable both for federal and state income tax, as well as for property tax, or for payroll taxes, the Social Security and Medicare taxes. There are some exceptions to that, which we'll point out, but pretty much across the board, if we're talking about an exception or an exclusion from taxable income, we're talking about all types of taxes, both income and payroll. So with that base, Susan, can you take us? Oh, no, wait. Before we go to Susan on that, we have another poll. Sorry about that. To gather a little bit more information about our audience, we'd like you to answer the question that's on your screen. What are the most important payroll issues to your organization? So you have several different options here to choose from: worker classification, reasonable compensation, per diems, free meals at cafeterias, fringe benefits such as $30 a month for gym memberships, non-resident alien issues, or the final answer that we have there is I don't know. As a reminder, you need to answer the polling questions not only to help us orient to our audience, but also to get CPE credit. So we'll give you a moment here to select your answer to make sure that you can get your CPE credit. So I think we've given you hopefully enough time on that. So we'll go ahead and close the poll. Maybe. There we go. So it looks like the majority, the largest percentage we have here are for fringe benefits, such as the $30 per month gym membership. Reasonable compensation is not too far second there. So it looks like we have a wide variety of issues, and we're going to be covering most of these, not so much the non-resident aliens today, but we will be covering those other topics. So if I've got it right, yeah. Susan, can you talk to us about what the IRS has been doing lately?
Sure. Thanks, Tracy. Good morning, everyone. So we're going to spend just a couple of moments and talk about payroll tax examinations and really what's happening out there in the landscape. And this is a very active area for the IRS at this point in time. They're really focusing on these ideas right here for worker classification, reasonable comp, per diems, free meals, cafeteria, fringe benefits, and non-resident alien taxation. And some of these, of course, have been impacted by the Tax Cuts and Jobs Act. And so we'll talk about that a little bit further on. But one of the things that continues to be a problem at the federal level and really at the state level, so you've got two different agencies or groups that can come in and look at your records and really be critical in terms of what they're looking for and why. So of course, the premise on all of this is tax money, right? We all want our share of your money, so we'd like to make sure that it's being taxed appropriately. And one of the areas that continues to be a problem, a very large problem, is worker classification. And with that regard, I just want to remind, folks on the call that the whole goal of the IRS and really most governmental or state agencies is payroll taxes. They want everyone to really be an employee. They want people to be an employee so they can have benefits, so they can get their money, a little bit sooner, et cetera. So the focus and the movement is towards employee classification as opposed to independent contractor. However, as many people on the phone know, we do hire independent contractors, and that group of people are very valuable. So when you're looking and trying to make a decision about are they an independent contractor or are they an employee, it's important to keep in mind three very important factors, which is what the IRS looks at when they actually look at the rest of these issues, including the worker compensation or classification. Does the company have the right to control the individual behavior, how they do their work or what they do or when they do it? Can they control the business aspect of the worker's job? And that means can I can I tell you that you have this deadline and you have this due? In other words, control what you do and how you do it. So the last one is, what is the relationship between the individual and the organization? So if you, as an organization, have the right to control and the right to the business piece of that person's job, even if you've got a really nice contract written that everyone signed, it is very possible for an agency to come in and say, we don't think that agreement is appropriate. We still think this is an employee-employer relationship. So we are seeing quite a few worker classification examinations, and the majority of those have occurred in what I'd say a little bit more aggressive states. California is one of those states that is really pushing for this situation. Reasonable compensation, we will get into that a little bit later. Per diems, free meals, fringe benefits, these next three areas have changed significantly as a result of the Tax Cuts and Jobs Act, and we will get into those a little bit more, but it's very important when you're looking at your benefits now to actually classify them and make sure that they're being appropriately taxed and reported to your employees. So let's talk about our next slide here. And I want to, just as a reminder, probably many of you already know this, but as a reminder to everyone, the idea of an accountable plan versus a non-accountable plan has not changed. This is still an overarching principle of how benefits either become taxable or non-taxable, and whether or not they can be excludable or they have to be included in employees' compensation. So we talk about, accountable plan, non-accountable plan, and many times this really turns itself into an employee policy or a handbook, if you will. So the word plan, you can just sort of substitute the idea of a policy or a program, or this is how we operate, sort of an employee handbook. The important things to always keep in mind when you're doing these types of plans is there has to be a business connection. You have to have substantiation, and you must return any excess advances you may give an employee. And so if you have all of those elements in your plan, program, or handbook, that will allow you to exclude some benefits versus others. I had a question recently about substantiation. What is substantiation? And substantiation is proof from an employee that they actually incurred the expense. So, that would be then reimbursable to them on a non-tax basis. What we would say, going back to the examination process and having regulators come in and look, substantiation needs to occur contemporaneously, in other words, more frequently than annually. So if you're doing a true-up and you're looking at benefits and you're doing sort of this, we're reimbursing employees, it needs to really be on a very consistent or timely basis. So we would just remind people to make sure that you look at this sooner than later. Now we're going to switch gears a little bit and really get into some of our benefits and talk about the structure and how that looks. And most people probably have a cafeteria plan or a Section 125 plan. And these types of plans are really a wonderful opportunity if you do any cost sharing with your employees for benefits. It allows the employee to elect to have their share of the health benefits or other types of benefits, health savings accounts, taken out of their compensation on a pre-tax basis. And when I say pre-tax, this is no Social Security, no Medicare. It comes off the top without ever hitting their W-2 because they have elected benefits as opposed to wages. So you can allow, of course, health and accident and health benefits, adoption assistance, health savings accounts. So it's a great plan at the federal level. It works really, really well. What I point out here at the very end of this is that there may be a difference in state tax treatment, which means that some states may not recognize the pre-tax benefit at the federal level that employees get, and you may have to add these benefits back into compensation for state taxation purposes. So it's really important to know that we're talking at the federal level. This is pre-tax. It's great. At the state level, you'd have to actually go into your state details and see whether or not it's added back in for tax purposes there. So we're going to switch gears here a little bit, and Tracy's going to talk about some exceptions to some of our fringe benefits.
All right. So in your materials that supplement the PowerPoint slides that we have here, we've given you a couple tools to put in your tool belt, pull out later when you need them. The first one is a Word document, a 132 table that I put together based on Section 132 with the 8 exceptions that you can see on the screen here. And that table I've got screenshots of in the PowerPoint slides that are a little hard to read, so I encourage you to pull that 132 table out of your materials. It's just 2 pages, but it's helpful to be able to refer back to so you can see the requirements in order to use these exceptions to provide benefits to your employees on a pre-tax basis or a non-taxable basis. Additionally, in the materials, we've given you an article that we wrote several years ago relating to employer-provided housing. Super helpful article to walk through the convenience exception that we'll be talking about. We've given you IRS Publication 15B, which is the Employer's Tax Guide for Fringe Benefits. That's updated every year. Super easy to follow and search if you're looking for information from the IRS specific to certain benefits and certain exceptions. I gave you a couple pages from IRS Publication 5137 that has a flow chart on when the working condition fringe benefit can be used, as well as an educational assistance chart that I refer to all the time when I get questions on providing education benefits. And finally, we have an article relating to the Tax Cuts and Jobs Act, so the tax reform, and how it changed the meals and entertainment deduction. That's going to be applicable for those on the call if you either have a for-profit subsidiary, for example, maybe you have a taxable C corporation, so they're following the normal for-profit rules. They may be affected by that change in meals and entertainment. It's possible you could have unrelated business income that's actually a trade or business, not just passive investment, and you'd be, in some cases, taking an actual meals or entertainment deduction as part of the expenses of receiving that unrelated business taxable income. So in those instances, you might be interested in what's in that article. If you are just a nonprofit organization, you don't have UBIT, you don't have for-profit subsidiaries, there's no change for you in the meals and entertainment area as it relates to being able to take deductions because you have tax exemption. So nothing in those rules that I'm aware of have made those benefits taxable to employees, but we'll see if anything pops up as we have a further discussion on that. So the exceptions that you see on your screen, 1 through 8, we're going to talk about the first 5 in a bit more detail in the subsequent slides. We're not going to be going over number 6, qualified moving expense reimbursement, because as of January 1st, 18, the Tax Cuts and Jobs Act did away with that exclusion. So now if you're providing qualified moving expense reimbursement to your employees, that will be taxable to them for income tax purposes and payroll tax purposes, just as if you, say, gave them a bonus. So that's been a huge change in the landscape. 7 is for qualified retirement planning services, no changes there. And 8 is for qualified military base realignment and closure of fringe. Also no change in that area. I have a note at the bottom of the screen because I give this presentation to quite a few college and university audiences. And I included in case if we have any of those on the call today. Section 132J8 says that education or training can only be excluded from your employee's taxable compensation if it's under 127 or as a working condition fringe. So I occasionally have schools that try and use the no additional cost service or, say, a qualified employee discount or a de minimis type argument. The code specifically says you can't do that. You've either got to fall under 127, which you can look in your materials at the table on what is required to take advantage of that, or under the working condition fringe. So with that, we'll get into a bit more detail. This is a picture of the table. As I said, it's very hard to read on screen, so I refer you to your materials so that you can see it in more detail. In order to use the no additional cost services, we have to meet a couple of requirements, and that's what we have on the bullet points in the table there. The first one is that the service has to be offered for sale to customers other than employees in the ordinary course of the line of business of the employer in which the employee is performing services. So say, for example, you have a for-profit company that has an airplane division, and they have a bus division. You are selling tickets in the normal course of your business, and so you can possibly use this exception to let your airline employees fly standby last-minute seats on an airplane. That's in the normal course of business in which they're providing services. Now, it could be argued that if you try and provide that same benefit to an employee in the bus division, that's not really in the same line of business as the airline company, depending on how you classify it. So giving the bus employees the option of flying standby on the flight may not qualify here as a no additional cost service. The other factor to consider is you have to be providing it for sale to customers. This can't just be something that you are providing to employees and say it's a no additional cost service. You've got to have a market for what you're trying to provide to them tax-free. The second factor is the employee has to incur, or the employer incurs no substantial additional cost, including foregone revenue, in providing such service to the employee, and it's determined without regard to any amount paid by the employee for such service. So I run into this all the time with colleges and universities that have athletic programs, and they have game day tickets, right? If you allow the employee to take up a seat that would have been sold, say it's a sold-out game because you have a very popular athletic program, or you're providing it to the employee 2 weeks ahead of time, the IRS will argue that you have foregone revenue by giving that ticket to that employee, and therefore you cannot provide it to them tax-free under this exception. It's possible we might have some other exceptions, but you can't use this one in that case. So the question I often get is, well, how soon before game time do you have to wait? And the answer is the closer to game time you get, the better argument you have that you have no foregone revenue in providing that ticket to the employee. So if you have, say, tickets to a bowl game and it's always sold out, you're going to have a harder time making that argument than if you have games that are never sold out and you're giving them seats where there is frequent vacancies. So it depends on your facts and circumstances, which is the whole purpose of our discussion today, is to provide you with the framework so you can apply your facts and circumstances. The third bullet point is that the benefits are available for retired and disabled employees, surviving spouses, current spouses, and dependents. So it's more than just your employee. You could provide a couple game day tickets an hour before the game starts, and that would be acceptable and not taxable. There is a reciprocity piece to this, so it's possible to provide this exception to employees of another employer. You'd want to look up the details on that one. And finally, it's only available to highly compensated employees if there's no discrimination. So if you only provided game day tickets to your C-suite executives, you couldn't use this exception to exclude those tickets from their compensation because there is a discrimination element. But if it's a first come, first served or some sort of lottery program, then you might be able to use this exception. The bottom half of our screen here is for the qualified employee discount. It's an awful lot like that no additional cost service, but in this case, you are allowing a discount either on the sale of property or on providing of a service. So the employee discount is the amount by which the price that you would normally sell it exceeds the cost, right? So your profit. And if it's a service, you can provide up to 20% off of the price at which the service is being offered by the employer to customers. So, for example, let's say you have a bookstore and you allow your employees a 30% discount when they buy at the store. If they're buying tangible items, you can exclude the profit percentage or the gross profit on the sale of that item. But if it goes below cost, the amount below cost would be a taxable benefit. If you have IT services in your bookstore and you're allowing a 30% discount on those IT services, the first 20% would be excluded potentially under this exception, but the additional 10% would be taxable to them. So you've got to look at the amount of the benefit that's being provided. A qualified property or service, you cannot use this for real property or personal property held for investment, and it includes only property or services offered for sale to customers in the ordinary course of the line of business in which of the employer in which the employee is providing services. So providing a bookstore discount to employees of the bookstore is a no-brainer. They're working in the line of business, and the bookstore sells to normal customers in the course of their business. But you've got to look at your facts to see how far you can expand that. If you have an employee, say, who works at a satellite campus and has nothing to do with the bookstore, can you still say it's in the same line of business, and are they still eligible for that discount? The same group applies where the benefits are available for retired and disabled employees, surviving spouses, current spouses, and dependents, and we do have that same non-discrimination requirement if you're going to provide this benefit to a highly compensated employee. So when we start applying these first two and subsequent 132 exceptions, I thought we'd start with meals and entertainment. So we have meals and housing on this screen, both of which can be excluded from your employee's taxable wages due to a convenience of the employer exception. Now, there's certain requirements that go along with this. For meals, the code says that the employee's continued presence on the premises needs to be necessary to enable the employee to perform their duties properly or to supervise others. So let's say you have a hospital that's in a rural community, and really the closest place to eat is 20 minutes away, but due to your staffing issues and your personnel, there are certain positions that are only allowed a 45-minute lunch break. It doesn't provide them enough time, realistically, to go and get food and come back. So if you were to provide meals on premises for that person, you might be able to make the argument that their continued presence is required or expected. Another one might be that they need to be available for emergency calls. So if you have a doctor who's in the ER, has to be available, you only have so many of them, they really can't go off-site for meals. This exception for the convenience of the employer might allow you to exclude those meals from their wages. The final one is the service says that you need to show a substantial non-compensatory reason if one of those doesn't work. So they did leave the door open for some interpretation, but there's not a whole lot of wiggle room here.
And so, Tracy, what we are seeing with this convenience of the employer sort of piece, the Internal Revenue Service recently put out a notice that provides additional guidance on this for companies and organizations to consider. And so we would say if you have a convenience of the employer and that is an area that you believe works for your organization, we would recommend that you look at some additional considerations and documentation requirements that the IRS is starting to look at now to help support this this convenience of the employer position.
Mm-hmm. And a lot of the articles that I've been reading and the concern I've been hearing from the service is they're really worried about these very lavish meals and the press that's been coming out of some areas, including the high-tech sector, very lavish meals. And so by having this kind of in the face of the service, it's been an area for quite a while that's been on kind of a watch list. So it's certainly an area where if you are excluding a lot of meals from your employees' wages, you want to have buttoned down in your files and well documented. If you can't use the convenience of the employer exception under 119 that we just talked about a minute ago, you might be able to use the working condition fringe, which was the third one on that 132 slide that we had, or the de minimis fringe, which is more for occasional company picnic, cocktail parties, coffee and donuts, those types of things. So to give you a little more meat on the bones of those two exceptions, our screen now has the next two the next two 132 exceptions that are on that handout. So if you can't read the screen, I encourage you to go to the handout. So a working condition fringe is any property or service provided to an employee of the employer to the extent that if the employee paid for the property or service, the payment would have been allowed as an ordinary and necessary business deduction or as a depreciable item. So, for instance, I'm on a business trip right now. I'm in Boston, and I'm traveling. And so if I pay for my meals or lodging while I'm here, this is an ordinary and necessary business expense. If I paid for it, and before tax reform, I would have been able to deduct it on my Schedule A as an employee unreimbursed expense. If Moss Adams reimburses me for the trip, they can do that in a tax-free manner because it's an ordinary and necessary business expense. Susan, did you have anything else to add, especially related to tax reform or anything on working condition?
No, I think we'll get a little bit more to that, but it's enough to note that the working condition fringe benefit exclusion needs to be approached a little bit carefully and documented in a way that supports your position. It's a little trickier to do now with tax reform. Doable, but still a little tricky.
All right, so the other one we have up on screen that I mentioned in relation to meals is the de minimis fringe. And I see the de minimis fringe abused all over the place, not nearly well documented as it should be. So the first criteria to use the de minimis fringe, and this is to provide a benefit to an employee and have it be non-taxable for income and for payroll tax purposes. The first criteria is it's any property or service, the value of which is, after taking into account the frequency with which similar fringes are provided by the employer to the employees, is so small as to make accounting for it unreasonable or administratively impractical. Now, that does not mean I don't want to track it, and so therefore it is administratively impractical to track. That's not the criteria. It's that it actually needs to be impractical to track. So if Moss Adams has a company picnic and we provide everybody with shirts, right, that by default is taxable unless you can find an exception. But we only do it once a year. The shirts cost, $5 a piece. You don't really keep track of who comes and who doesn't come. You just order a bunch of sizes and you've always got some left over when you do it that way. So that really is administratively impractical to track, and it's infrequent because it happens once a year. Now, if I start giving my employees clothes every Friday, say we have a different shirt that comes out every Friday, that frequency could tank the ability to use the de minimis fringe. If I take my employees out once a month for cocktail hour after work as a camaraderie, that's not real frequent. Once a month, it's probably fine. If you're doing it every week or every day, the frequency starts getting to be an issue. So you've got to look at your fact pattern and see if you can, with a straight face, make the argument that it's impractical and administratively or unreasonably and administratively impractical to track, and it is not frequent. The second factor is you include certain eating facilities operated by the employer or a third-party contractor if the facility is located on the business premises and the revenue derived from the facility normally is at least the direct operating cost of the facility. So this is a second way that we can use the de minimis fringe. If I'm going to run a cafeteria and it's on my business premises, or I'm going to bring in a third party to run it, if the employees at least pay for the cost of operating it, then the IRS is not going to have additional taxable compensation to them just because they're getting a meal that if they bought it themselves would have cost $40, but because they're only having to cover the cost of it, it only costs $10, they're not going to tax the employee on that spread. The final way that we can use the de minimis fringe relates to on-premises gyms and other athletic facilities. And this one is often misused because people don't look at the requirements here. It has to be on the employer's premises, operated by the employer, and substantially all of the use has to be by employees, spouses, and dependents. So this exception does not apply if you're a college or university and you have a student athletic facility, the normal athletic facilities that you would see on most campuses, and you allow your employees to use it. You can't use this fringe for that because the premises is not primarily for use by the spouses and dependents and the employees. Also, if you have one of those facilities that it is primarily for employee use, if you restrict it only to highly compensated employees, you can't use this exception. And now with tax reform, if you're a nonprofit, it's now unrelated business income for you. So I have never seen one of these highly compensated employee-only gyms in my nonprofit work. I'm sure that they're out there, or it wouldn't have been here in the code. like I said, I often see this used inappropriately for gym facilities, which are for primary use by patients, residents, or students, not by employees. So when we go back to our slide on meals, we've talked about the ways to exclude meals. For housing, for the convenience of the employer, you have to meet a couple requirements. The first one is that it has to be furnished for the employer's convenience. The second one is it's required as a condition of employment. Those are often seen together. So in order to do their job, they have to take the housing and they have to be there in order to perform the service. You've got to be able to show that. And then it needs to be on the business premises, either where the business activity is actually occurring, or if they're away from the business where business is normally occurring, then significant business is happening in the residence. So for example, on campus you have an RA. They're required to live in the dorm. They have to be there in order to do their job, and it's on campus. Easy, no-brainer. That meets the convenience exception, unless if you allow them to do something else. If you said, we'll give you free housing or we'll give you a stipend if you want to live off campus and just come in periodically, that doesn't work. They got to take the housing. That same college, if they have a president's house that's 2 miles from campus, that's not on campus. It's not on the business premises. But if you can show that significant business activities need to be conducted in that house and the president needs to live in that particular house in that area and they're conducting business there, then you can make the argument that the convenience exception applies. And my article goes into that in more detail, so I will leave it there in the interest of time. Transportation benefits. If you have a company-provided vehicle, it can be excluded as that working condition fringe that we mentioned, a normal business purpose expense, but you're required to maintain a log of the business usage, and failure to provide adequate accounting of those business miles results in the value being fully taxable. So if you have a concern in this area, there's not been a change here recently. This has been around for a long time. You'll want to see IRS publication 463 for the vehicle valuation method and details on maintaining that log. Spouse travel is a huge area of dispute. The code is very clear that the spouse travel must have a bona fide business purpose in order to be non-taxable to the employee. And documentation is key in that case. I've seen this come up on audit. The IRS by default says all spouse travel is taxable. So some things you might consider is having an employment agreement with the spouse on what their duties are and what they will be paid for. That because they are then an employee themselves, it takes it out of the spouse travel rules and just puts it into the normal employee travel rules. I have also seen volunteer agreements with spouses of very key personnel at exempt organizations that outlines the duties and what will be reimbursed and what will not be reimbursed. They still aren't an employee if they're a volunteer, so you haven't removed it from these very onerous spouse travel rules, but it is at least another form of documentation to show that that business travel does have a business purpose. If you don't have appropriate documentation, the travel will be taxable to the executive. And if you're a 501c3 organization, you have the added layer of the automatic excess benefit, penalties, required reporting, required repayment. It's very onerous. So just be very careful on spouse travel. And just because the board feels the spouse needs to be there, or it's been the culture for the spouse to be there, that does not always and often frequently does not meet the IRS standards. So this is a huge area that I see, not necessarily from a dollar standpoint, but of a PR and a risk standpoint for the exempt organizations that I consult with on spouse travel. Qualified transportation fringe, we have seen a significant change in this area, not on the employee side, but on the employer side. So this, again, is a screenshot of the 132 table that you have in your materials. So these qualified transportation fringes are benefits that can be provided in a non-tax way within limits to employees. It's capped at $265 for 2018. It increases for inflation for 2019. Any benefit provided above that is taxable to the employee, so that has not changed. What has changed is now if you are an exempt organization the amount that is provided tax-free to the employee, or you allow them to use pre-tax money to buy, that is now unrelated business income for you. And they've added a layer of complexity that I don't think anyone saw coming, where not only is this if you pay, say, a third party to lease spaces, or it's included as part of your office lease, and so the employer actually has an out-of-pocket cost every month for providing these parking or transit benefits. If you own a parking lot, that too now can cause unrelated business income for the exempt employer that's providing those employee spots. So it's a very complicated area. We just received a couple notices, which I have in red at the bottom of your screen. IRS Notice 2018-99 and 2018-100. If you are not already thinking about your parking situation, you want to do that as soon as possible because these rules changed as of 1/1/18. So whether you are calendar year or fiscal year, we are in the heart of filing tax returns that now have this taxable benefit on it. Now, if you're on the for-profit side or you have a for-profit entity or you were deducting the expenses as part of unrelated business income, those expenses up to the $260 or $265 now are just non-deductible for those organizations. If you were providing a bicycle benefit, the ability to do that in a tax-free manner went away as far as tax reform. So effective 1/1/18 through 2025, that bicycle commuting benefit will now be taxable. So in the interest of time, I'm going to move on because we could spend hours on that topic there. Gift cards and awards, I run into these all the time. Gift cards are always treated as cash. It doesn't matter if it's a $5 Starbucks card, it's cash, and it's supposed to be taxable. Now, you got to look at the practical side of things. Can you really track $5 gift cards? The IRS says you can. They don't allow you to use the de minimis fringe here, but you've got to think about the risk to your organization compared to the amount of time and effort of tracking it. A lot of my organizations have just said, no gift cards, we just aren't going to allow it. There are potential exceptions for very restricted certificates, like a certificate to Vons for a turkey or ham is extremely restricted, and you might be able to make the argument that that is not cash. For awards, we have several different exceptions that we can use. The qualified scholarship under 117, outside of higher ed, I don't see it that often, but it is a potential. And you'd want to look to make sure your pool of potential candidates is sufficient enough to allow that qualified scholarship exception to apply. There is one for a meritorious achievement given to a government unit or charity designated by the recipient. So if I wrote a really great paper and someone wanted to give me an award, and before I get it, I say, wait, don't give it to me, give it to the University of Idaho, I won't have constructive receipt, and therefore it won't be taxable to me if I am diverting it to a government unit or a charity designated by myself. The Employee Achievement Award we run into all the time. The Tax Cuts and Jobs Act changed this area a little bit by better defining what tangible personal property is. And so if you're giving a length of service award, for example, and you're giving a gold watch, you're fine as long as you're within certain dollar parameters of that program. But if you're giving a vacation to Hawaii or you're giving them event tickets, that is clearly now no longer treated as tangible personal property and therefore will be taxable if you provide it to the employee, even for length of service or safety. We can use the de minimis fringe here that we talked about a little bit ago, where it is infrequent and impractical to track, but it's got to be very low value items typically and not happening very often. So if you're giving away iPads, it's less likely that you're going to be able to use the de minimis fringe. If you're giving away sweatshirts a couple times a year, much more likely that you can use that exception. On your screen is a shot of the handout that is in your materials if you have further questions about providing education benefits. This is a very helpful table to identify what types of expenses can be covered, who it can be given to, and how to exclude it. So I will skip it and you can see it in more detail in your materials. Cell phones we know are very prevalent. If you have cell phones that you are providing to your employees for business purposes and you've documented the business purpose, like they're a salesperson, they're traveling around, they're required to be available 24/7, those types of positions, we're not seeing any problems with them. You can provide the cell phone. You can provide allowances within certain restrictions. But if you have an administrative person who's at a desk with a landline Monday to Friday, 9 to 5, you're not going to be able to make the business argument there. But you just want to make sure your employment files have it well documented why they have the cell phone. For leave policies, there are 2 exceptions. You've got medical emergencies and major disaster exceptions. So if you have a situation where you want to allow one employee who earns leave to donate it for use by another employee, you'll want to look at those exceptions. It can be done, but you've got to make sure that you're aware of the restrictions ahead of time. Susan, do you want to chat about retirement plans?
I do, because this is one of my areas of special interest. I love retirement plans. So what we have on the screen here is 401k plans, 403B and 457B plans. These are very typical plans offered in the not-for-profit governmental area. Also the 457F plans for non-qualified deferred compensation. So it's just a quick reminder in the kind of essence of time. We're just going to quickly talk about a couple of things. In the 401k, 403B, Roth options, employee deferrals, employer contribution limits, and special catch-ups. So the special catch-up only, all of these 3 plans allow special catch-ups, which I think is lovely. However, for the 457B plan in the not-for-profit sector, there are no catch-up contributions allowed. If you are a governmental employer or quasi-governmental and you fit within that framework, you will be allowed to have a special catch-up contribution for the 457B plan. But 457B plans don't allow other special catch-up opportunities. So this year, the contribution for deferrals is $19,000. It's the same amount across the board for the 401k, 403B, and 457. And then the catch-up opportunity in the 401k and the 403B plan areas are $6,000 this year. So for a 457B plan, you can either have employer or employee contributions, but the limit is $19,000 in the not-for-profit sort of non-governmental area. In the governmental area, you do get a special catch-up. And that's a sort of an important distinction. The other allowable catch-up in a 457 plan, if you meet the criteria, of course, is a special 3-year or 15-year amount calculation that allows you to catch up some previously uncontributed amounts into the plan if you meet those rules. So in the not-for-profit sort of 457 area, non-qualified deferred compensation plans, many organizations have these plans, and what we are seeing now is that some of these programs and some of the benefits that have been accrued in those programs and the vesting terms are causing compensation to exceed the $1 million amount for the year, which then, of course, under the Tax Cuts and Jobs Act, creates a 21% excise tax problem. So just kind of a quick note to people, with regard to the contributions, make sure that the contribution limits are being properly, attended to. If you do have an excess contribution in your 457 plan, make sure it's taken out timely within a couple of months after the following year of the event to keep your plans in compliance. They're difficult to fix, shall we say. At the bottom here, there are a couple of additional resources for you that will take you out to the publications that will provide you with a little bit more information. So I also want to briefly touch on this just one more time. We talked about it a little bit earlier, but I want to let folks know that, even though the IRS really would like everyone to be an employee, there are special circumstances and there are actually very valid reasons for people to be classified not only as an employee but as an independent contractor. And as long as you sort of look at these 3 factors, so the IRS took what we like to refer to as the Microsoft 28-factor test, are you an employee or not? and put them into 3 different factors. So they divided that test up, put them into the behavioral, financial, and relationship aspect that we talked about earlier, and they're using this to control their determination. And so the Ramirez versus Commissioner basically came down and said Ramirez is not only was an employee of his employer, but he also performed independent contractor duties, and therefore he was entitled to also be considered an independent contractor for reporting. So it's possible to have both sides. You want to be very careful about the structuring of that relationship. So what we'd like to do now is have a polling question and just ask the group, will the Tax Cuts and Jobs Act, a new excise tax, impact your organization's compensation strategy? And so if everyone would just take a moment and answer that, we will be able to move on to our next section here. And let's go ahead and get the results and see where we are. All right, so here we are. So quite a few people don't believe that the Tax Cuts and Jobs Act will have any impact on your organization's compensation strategy or benefits that you may offer to your executives. So, and then it's kind of split between yes, there might be an impact and not sure. So let's move on. Tracy, can you walk us through some of the issues that executives and organizations may face under the Tax Cuts and Jobs Act?
Sure. So the first one that we're running into, and it's kind of split. You've either got very highly compensated employees in your organization or you don't. So I'll move through this relatively quickly because this is more for the highly compensated side. So we have a new 21% excise tax that's due from the exempt organization. This is not a tax on the employee. This is one the employer pays. If you have covered employees who are paid in excess of $1 million by the filing and related organizations, or if you have excess parachute payments paid to covered employees. So you don't have to be paid over $1 million to be subject to the excise or to the excess parachute payments. They're just considered in 2 different buckets. This excise tax we just received guidance on New Year's Eve, I believe, was when the notice was issued. And it clarified that it's going to be based on calendar year compensation that falls within the fiscal year end that begins after 12/31/17. So if you are a 6/30 year end, this is going to be effective for your tax year beginning 7/1/18, but it's going to be the calendar year compensation that falls within that fiscal year. It's a little confusing. We're going to have to walk through it. But as we thought, the IRS was probably going to default to what was easier for them, which was tying more closely into W-2 wages as opposed to fiscal year wages, because that's what we're reporting on the 990. They have cautioned in the notice, though, that it won't necessarily tie to your Box 1 W-2 wages because you may have some earnings that were vested but unpaid in the prior year, so before tax reform happened. So especially in this first year, we've got to be really careful. It's loosely going to be based on Box 1, but you've got to watch for amounts that were actually earned prior to the time period that the tax applies. So when I go, there we go. You really want to watch here for 457F. Those are your non-qualified deferred comp benefits because in the year of vesting, those will be taxable. So if you already have a highly compensated person, you're going to have more likely to push them over the $1 million mark and have more comp that is over that threshold. You also want to visit your bonus agreements to see if you have any bonus agreements in there that are going to push them over $1 million in an unusual circumstance. Once they're a covered employee, which is one of the 5 highest compensated employees for the tax year, or they were a covered employee in the prior year, they will always be a covered employee. So we've got to be a little careful here, make sure that we're tracking our covered employees for each year. Unfortunately, they didn't put like a 5-year time clock on this or anything with the notice, and that may change with proposed or final regulations when those are issued. We were all a bit surprised that it was the once a covered employee, always a covered employee. But again, they have to either make comp over $1 million or they have to have an excess parachute payment in order to be taxable. So it's going to be a little bit of a tracking issue for organizations that have a lot of highly compensated individuals. It applies to exempt organizations that are exempt under 501A1, farmer co-ops, public utilities, organizations that are exempt under 115 because they are exercising essential government functions, and that's how they are an exempt organization, and 527 political organizations. So quite a few organizations are going to be caught up in this potential new tax. It's going to be paid on Form 4720. That's due at the same time as your 990 is. It's 4.5 months after year end. It does require a separate extension. So if you think that you might be subject to this tax, you want to be thinking about it sooner rather than later to make sure you file an appropriate extension. Estimated tax payments are not required, so you don't have to worry about trying to make estimated tax payments, but you will need to pay the tax with that extension. That guidance that I mentioned was 2019-09, and you've got the URL here on your screen. You will also have a copy of these slides in your handout section, so you can go back to that URL. It is 95 pages, so it's a little daunting, but it's a lot of FAQs, and it's pretty well organized if you're looking for a particular answer. Susan, do you want to do a recap of the other changes?
I do, and before we move on to the fringe benefits, I also want to just note to the audience that 457F plans are also subject to another tax code that's very, very important. It's 409 Cap A, and 409 Cap A really dictates and sort of manages the flexibility of some of your 457F plans. So if you have some executives and payments that are on the horizon, it would really be a benefit to the organization and that executive to take a look at those sooner. And if you need to make plans, make sure that you're within the time period that you'll be allowed to make the plans without any negative tax impact. So just to quickly run through these slides, because we have just a couple of more moments, we talked about employee achievement awards. They're tangible personal property. Basically, cash is cash. Meals and entertainment, the employer got a deduction, 50%. Entertainment expenses are no longer deductible. The 50% is still in place, and their employee recreation exceptions, benefits, and parties still in place. Moving expenses no longer allowed. Bicycle expenses no longer allowed. They took a lot away. They left us a few things. Qualified transportation fringe benefits, employee exclusion still remains. Employer was taken away. The parking facilities, this is really an area that needs to be looked at carefully. We are still receiving guidance on this, so basically stay tuned. We have some additional guidance, but we need additional guidance. On-premise athletic facilities, Tracy talked a little bit about those expenses and how they are. Transportation benefits, this is just a situation and analysis that you can look at and read. This is a table right now that really talks about other resources. We put together a notice, kind of a what to do, what you can look at for additional information about these things. It's been kind of put all the way through the slides, but here's a little recap of some of the details and resources that you can use. New guidance is coming out all of the time, so just be prepared that things will change. You can just almost be guaranteed. Our last polling question. So, When was the last time your organization reviewed the benefits package offered to employees? And when we say benefits package, we're really talking holistically about everything you offer your employees, from benefits to retirement to, getting off work earlier, what that is. Recently, in the last 6 to 12 months, more than a year, less than 3, it's been more than 3 years. So take just a moment, because we have about 2 minutes left to get this question, and then let's see where we are, and then Tracy and I will wrap this up for you. So, let's see, Emily, do you want to close this out for us?
We'll go ahead and close the last poll.
Excellent. So this is great. This basically indicates that more than 50% of you are taking a look at your benefits, which is wonderful, how it impacts or may impact your organization and your employees. More than a year, less than 3, I might suggest that you kind of revisit. And for those who it's been more than 3 years, things have changed. We might suggest you take a look at things that it would probably be a good thing for you. And Tracy?
All right, so we wanted to provide you with a couple slides of takeaways and action steps that we've been talking about through the presentation, just as maybe a checklist to take back and think about. Under benefits, determining if benefits provided can be excluded from the employee's wages for income tax purposes, payroll tax purposes, or both. Maybe you've been already providing a benefit that we talked about, and you've been taxing it, and you heard that there's a way to do it maybe tax-free. Maybe you've been treating it as tax-free, and it should actually be taxable because you realize you don't meet some of the exceptions. So it's a good chance to revisit the existing benefits that you have, determine if benefits provided result in unrelated business taxable income if you are a tax-exempt employer, or are now non-deductible if you are a for-profit employer due to the tax reform changes, all of which were effective 1/1/18. So if you haven't already done this, you'll probably want to put it on to-dos for this week. Under compensation, you definitely want to schedule out when your deferred compensation plans may become vested so you can look and see if that $1 million threshold is going to be exceeded. Put together a list of your covered employees for 17 and 18 so you know who you should be monitoring, and identify those whose compensation may exceed the $1 million threshold within the near term, and consult if possible to make any changes to plans before vesting, as well as get that new form on your radar for filing when you do your extensions for your 990 and 990T. Susan, do you want to take our last one there?
I will take our last sort of as a reminder to everyone with the new tax changes that are coming out that are being implemented and looked at now. Excuse me, we suspect that the IRS will give people sort of a one-year honeymoon, if you will, with the changes and how they impact organizations, businesses, and employees. However, we want to remind people to review your benefit packages, make sure that your current expense platform is appropriately set up and that you're bucketing those expenses appropriately, not only for the organization but for your employees, for taxation and reporting. And then, if necessary, rewrite your expense policies that actually advise your employees, and you can actually show in fact or in case you get knock on the door by the regulators. So I think we are done and out of time. Thank you so much. Emily, would you like to finish this up for us?
All right. Thank you, Susan, and thank you, Tracy, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. And as we are short on time, we did not have a chance to get to all of your questions today. So if you have questions still for Tracy or Susan, you can submit them in the Q&A window, or you may reach out to them directly. And here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.